Welcome back, everyone. We're diving into Bill Cara's Global Market Navigator Report number 5 this week.
Yes.
Huge thank you to Bill for his work, by the way. You can find more of his insights at billcara.com. So for those of you who've been following along, we're going to be focusing on the key takeaways and changes from last week's report.
Okay.
Buckle up, because we're going deep on this one.
Yeah, we're assuming you've already got a handle on the basics, so we're going straight to the meat of the matter.
Exactly. And to set the stage, let's talk about the overall picture. Bill's report, this week it doesn't paint the rosiest picture. Global equity indexes took a bit of a tumble. Technicals are looking pretty bearish.
Yeah.
And the World Bank's global GDP growth projection of 2.7% isn't exactly inspiring a ton of confidence.
No, it's definitely a week for cautious optimism. What really jumps out at me from this week's report is the impact of the U.S.-Canada trade war.
Yeah.
Canada retaliated against those U.S. tariffs with a 25% tariff on 155 billion Canadian dollars worth of U.S. goods. And the Bank of Canada didn't just sit back and watch. They cut their key policy rate to 3% and issued a pretty strong warning about the potential damage of a full-blown trade war.
See, now this is where it gets interesting to me. Canada's inflation actually slowed down to 6.3% in December. You'd think that might give them some breathing room. But it seems like they're prioritizing stability over fighting inflation right now.
Absolutely. And the potential consequences of this trade war are pretty significant, particularly for consumers.
Yeah.
Think about it. The U.S. relies on Mexico for a huge portion of its produce, like 69% of fresh vegetables, 51% of fresh fruits.
Wow.
So any disruptions to that supply chain are going to hit consumers right in the grocery store.
Okay, so maybe we should be stocking up on avocados now.
Yeah.
Before the guac-apocalypse hits.
Well, it might not be a bad idea, but seriously, the impact goes beyond avocados. The U.S. lumber and cement industries are going to be hit hard, too, because Canada is their biggest supplier. We're talking higher construction costs, potentially impacting everything from housing to infrastructure projects.
And remember, Bill's warning about potential disruptions to American manufacturing, specifically cars and airplanes.
Yeah.
Apparently, some parts cross the border multiple times during production, so those tariffs could really throw a wrench in the works.
It's a prime example of how interconnected our supply chains are. And unfortunately for Canada, their economy is smaller and more reliant on trade with the U.S., so they're likely to bear the brunt of the damage.
It does seem like they're in a tough spot. And speaking of tough spots, let's take a look at the Canadian stock market, the TSX. What's Bill saying about that?
Well, he's highlighting the fact that the TSX is underperforming compared to the S&P 500. In simpler terms, that means Canadian stocks aren't doing as well as American stocks right now. And the technicals are showing some weakness, which could be a sign that investors aren't as confident about the Canadian economy in the face of this trade war.
Right. And this ties into Bill's broader warning about a potential market crash. He thought the J.P. Morgan earnings report might trigger it, but that didn't quite pan out. So are we still on the brink of a crash, or is that fear overblown?
Well, one of the warning signs Bill is pointing to is what's called narrowing market breadth. Think of it like a party, where only a few people are dancing while everyone else is standing around. It might look lively from a distance, but the reality is that only a few stocks are pushing the indices higher while the rest are lagging behind. That can be a sign of underlying weakness in the market.
So it's not just about the overall numbers. It's about the strength of the market as a whole.
Exactly. We need to look beyond the headlines and understand what's really driving the market.
Okay, so that's a good reminder to stay vigilant. Now let's zoom out a bit and talk about international markets. What are some of the key trends Bill's highlighting in his report?
Well, Europe is showing a bit of a mixed bag. The French and German markets are looking relatively strong, but the UK market is showing signs of being overbought. That means it might be due for a correction or a dip in prices.
Interesting. So maybe not the best time to go all in on British stocks.
Probably not. On the other hand, the Brazilian market is still showing bullish momentum, but it's also potentially overbought. And the Chilean market looks like it could be approaching a long-term cycle top, which means it might be a good time to take some profits off the table if you're invested there.
So there are some potential warning signs in those markets. Anything else jumping out at you from Bill's global market overview?
One surprising piece of news is that Argentina actually balanced its budget for the first time in 14 years.
Wow.
They have a new president, Javier Milei, who's implemented some pretty aggressive austerity measures, which means cutting spending and raising taxes.
Wow, that's a big change. But how are those austerity measures going over with the people?
It's definitely controversial. Some people argue that it's necessary to get the economy back on track and attract foreign investment. Others worry that it's going to hurt the poorest citizens and lead to social unrest.
So it's a bit of a gamble, but it could potentially pay off in the long run. High risk, high reward, as they say.
Exactly. Time will tell if it's a sustainable strategy, but it's certainly shaking things up.
Okay, so we've talked about the big picture, but let's get into some specifics. What about sector-specific trends? Where does Bill see the opportunities and challenges right now?
Well, as we've already touched on, consumer discretionary and industrials are both facing headwinds due to those tariff concerns.
Yeah.
But let's look at some other sectors. The energy sector is in a really interesting place right now. We're seeing a global shift towards renewable energy sources, but traditional oil and gas companies are still major players.
It's like a tug of war between the old and the new.
Yeah.
How does that play out for investors?
Well, it creates both opportunities and risks. Companies that are successfully transitioning to a more sustainable model are likely to see growth, while those clinging to the old ways might struggle. It's all about adapting to the changing landscape.
Makes sense. What about the tech sector? That's usually a hotbed of innovation and growth.
Tech is still a major driver of the global economy. But Bill is urging caution when it comes to certain tech stocks. He highlights the risks associated with aggressive stock buybacks, using Citi as an example. He argues that buybacks can sometimes be a sign that a company is more focused on short-term gains than long-term value creation.
So it's a reminder that even in a sector known for growth, there are still potential pitfalls.
Absolutely. It's crucial to look beyond the hype and understand the fundamentals of the companies you're investing in.
Okay, that's great advice. Now, I know healthcare is a sector you're particularly interested in. What's Bill saying about that?
Well, healthcare is facing a lot of uncertainty right now, especially with Robert F. Kennedy Jr. as the new Secretary of Health and Human Services. His views on vaccines and pharmaceuticals have sparked a lot of debate, and there's a lot of apprehension about what his policies will mean for the industry.
Definitely a lot of unknowns there. What's the potential fallout for investors?
There's a lot of speculation about how his policies will impact drug pricing, regulation, and research funding. It's too early to say for sure what the long-term consequences will be, but there's definitely a heightened level of risk in the sector right now.
So maybe not the best time to bet big on healthcare stocks.
It depends on your risk tolerance. Some investors might see this as an opportunity to buy on the dip, hoping that the market is overreacting to the uncertainty, but it's a gamble, for sure.
Okay, a high-risk, high-reward scenario. What about other sectors? Anything else worth highlighting?
Well, Bill also takes a look at the real estate sector, which has been facing its own set of challenges in recent years. Rising interest rates have put pressure on the housing market, and there are concerns about a potential oversupply of office space.
It's definitely a complex market. Are there any bright spots in the real estate landscape?
Well, there's some optimism about the potential for a rebound in industrial real estate, especially with the growth of e-commerce and the need for more warehouse space. But overall, the sector is still facing some headwinds.
Okay, so maybe not the time to go all in on real estate either. What's an investor to do with all this uncertainty?
Well, remember Bill's emphasis on self-education and critical thinking. It's crucial to do your own research, understand the risks and opportunities, and make informed decisions based on your individual circumstances. Don't just blindly follow the herd or chase the latest trends.
That's solid advice. And remember, you can always find more of Bill's insights and analysis at billcara.com.
Absolutely. His work is an invaluable resource for anyone looking to navigate the complexities of the global market.
Okay, so we've covered a lot of ground here, from trade wars to emerging trends in technology and healthcare, but we're just getting started. When we come back, we'll be diving even deeper into some specific investment ideas and strategies from Bill's report.
You know, one thing that really struck me in this week's report is Bill's focus on the power of self-education.
Yeah.
He constantly emphasizes the importance of investors understanding the market, not just blindly following someone else's recommendations.
That's so true. It's easy to get caught up in the hype or panic, but taking the time to educate yourself can make all the difference in making sound investment decisions.
Absolutely, and that's where Bill's work comes in. He doesn't just give you the answers. He teaches you how to think critically about the market and develop your own investment strategy.
And speaking of strategies, let's dive into some of the specific opportunities Bill is highlighting in his report. He talks a lot about this idea of physical intelligence AI systems that can actually interact with the physical world.
Yes, that's one of the most exciting areas of innovation right now. We're seeing this convergence of AI and robotics that's revolutionizing everything, from manufacturing to healthcare to transportation.
It's mind-blowing to think about the possibilities. I mean, we're talking about machines that can learn, adapt, and even make decisions in real time. But how does this translate into actual investment opportunities?
Well, Bill highlights NVIDIA as a leader in this space. They're developing the hardware and software that's powering this AI revolution. They recently unveiled their new Blackwell AI processor and Cosmos platform, which are specifically designed to accelerate the development of autonomous machines.
So if you're looking to invest in the future of AI and robotics, NVIDIA might be a good place to start.
It's certainly a company worth watching. They're at the forefront of this technological shift, and their growth potential is enormous.
Okay, so we've got AI and robotics on our radar. What other sectors is Bill bullish on?
He's actually quite optimistic about the long-term prospects of the biotechnology sector. There are some incredible advancements happening in gene editing, synthetic biology, and personalized medicine that have the potential to transform healthcare as we know it.
I've always been fascinated by biotech. It feels like we're on the cusp of some major breakthroughs that could have a huge impact on human health and longevity.
Absolutely. But Bill also cautions against getting too carried away with the hype. He points out that some of the leading biotech stocks are currently overpriced and could be due for a correction.
So it's about being selective and discerning, not just blindly jumping on the biotech bandwagon.
Exactly. It's about understanding the science, the potential, but also the risks involved. Bill suggests focusing on companies that are developing innovative products in the later stages of clinical trials, companies that are closer to bringing those groundbreaking treatments to market.
Okay, that makes sense. It's about investing in companies that have a clear path to profitability, not just a promising idea. Now, I know Bill's big on value investing. He talks a lot about finding high-quality companies that are undervalued by the market.
Right.
He even has this thing called the Cara 100. Can you explain what that is?
The Cara 100 is essentially a dynamic watch list of companies that Bill believes meet his criteria for high quality. It's not a static list. It evolves as companies change and adapt. He uses it as a starting point for his own research, and he encourages investors to do the same.
So it's not a stock-picking service. It's more like a curated list of companies worth investigating further.
Exactly. It's about empowering investors to do their own due diligence and make informed decisions. And one thing Bill really emphasizes is the importance of understanding a company's capital allocation strategy. He's very critical of companies that engage in aggressive stock buybacks.
That's interesting. Why is he so against buybacks?
He argues that buybacks can sometimes be a sign that a company is more focused on short-term gains than long-term value creation. He uses Citi as an example of a company that's potentially making that mistake. He believes that companies should be investing in research and development, expanding into new markets, and creating products and services that will drive sustainable growth.
So it's about looking beyond the hype and understanding how a company is actually using its capital.
Precisely. Bill is all about investing in companies that are fundamentally sound and focused on building long-term value.
That's a philosophy I can definitely get behind. Now, I know we've talked a lot about specific sectors and companies, but I want to circle back to something you mentioned earlier, the importance of self-education. What advice does Bill give to investors who want to become more knowledgeable about the market?
He has a few key pieces of advice. First, he encourages investors to read widely. That means not just financial news and reports, but also books on history, economics, psychology, anything that can help you understand the broader context in which the market operates.
It's about connecting the dots, seeing the bigger picture.
Exactly. Second, he recommends developing a framework for analyzing companies and making investment decisions. This could involve learning about fundamental analysis, technical analysis, or a combination of both. The key is to have a systematic approach that helps you evaluate opportunities objectively.
So it's not just about following your gut. It's about having a process.
Right. And finally, Bill emphasizes the importance of being patient and disciplined. Investing is a marathon, not a sprint. It's about making informed decisions, staying the course, and not getting swayed by short-term market fluctuations.
That's great advice. It's easy to get caught up in the emotion of the market. But taking a long-term perspective is crucial for success.
Absolutely. And remember, you don't have to do this alone. There are plenty of resources available to help you learn and grow as an investor. Bill's website, billcara.com, is a great place to start. He offers a wealth of information, insights, and educational materials.
And of course, we're here to help as well. Remember to visit notyouradvisor.com and subscribe for more valuable content like this. We're always here to guide you on your journey to becoming a more informed and confident investor. Okay, so we've covered a lot of ground in this deep dive. We've talked about global market trends, specific investment opportunities, and the importance of self-education. But there's still one more key takeaway from Bill's report that I want to touch on before we wrap things up. And that's the idea of adaptability. The market is constantly changing.
Yeah.
And as investors, we need to be able to adapt to those changes.
Yeah. It's not enough to just have a solid investment strategy. You also need to be flexible and willing to adjust your approach as needed. Bill emphasizes that the one constant in the market is change.
So how do we become more adaptable as investors? What practical steps can we take?
Well, first and foremost, it's about staying informed. That means keeping up with the latest news and trends, but it also means going deeper and understanding the underlying forces that are shaping the market.
It's about connecting the dots, seeing the bigger picture, like we talked about earlier.
Exactly. Second, it's about being willing to challenge your assumptions. Don't be afraid to question your own beliefs about the market, and be open to new information and perspectives.
It's easy to get stuck in our own ways.
Yeah.
But sometimes we need to step outside of our comfort zones to really see things clearly.
Absolutely. And finally, it's about being prepared to pivot. That means having a plan B or even a plan C in case your initial investment thesis doesn't pan out.
So it's not about being right all the time. It's about being able to adjust when things change.
Exactly. The most successful investors are the ones who are able to adapt to the ever-evolving market landscape.
That's a great point, and it brings us back to Bill's core philosophy. Self-education, critical thinking, and adaptability. These are the essential tools for navigating the complexities of the market and achieving long-term success.
I couldn't have said it better myself. Bill's work is all about empowering investors to take control of their financial destinies.
And we hope this deep dive has given you some valuable insights and inspiration to do just that. Remember, you can find more of Bill's insights and analysis at billcara.com.
Absolutely. His website is a treasure trove of information and resources for investors of all levels.
And don't forget to visit notyouradvisor.com and subscribe for more valuable content like this. We're always here to help you navigate the complexities of the market and achieve your financial goals.
Thanks for joining us on this deep dive. We look forward to seeing you next time.
Until then, stay informed, stay curious, and stay adaptable.